with regards to using your capital to the most advantageous way you possibly can, cash in your company, uh, making it do more for you than or do as much for you as it possibly can. And so, one of the ways that you can do that is by leveraging cash, and that is in the form of a loan. Typically, is what we're talking about. We say leverage cash. You give somebody a down payment or give them some money, and you get a bigger asset in return. And the goal is hopefully that asset, tool, resource, whatever that is, in turn generates more gross, hopefully net money income that makes that payment for the loan and interest, worth it at that point. So that's traditionally that is how businesses would grow is by leveraging cash and getting a loan. And if you were to back that up and think about the way Granddad taught us how to run business, and there's still a lot of guys in the defense industry that believe this, is that they're very prideful in that, oh, I own all those trucks, or I bought that truck cash, paid up front. And I would be cautious of that, and definitely would not suggest that would be the habit. I don't think there's any real good value in purchasing something cash up front and paying for it and leveraging all your cash in one spot. In other words, if you could buy a truck for $60,000, if you could, $80,000, that's one truck, and it takes all your cash if you have 80 grand. Whereas you might be able to take 20 of the 80 grand, finance two trucks, and still have 60 grand to go buy inventory. And that's what I mean by leveraging cash. I'm going to back that up when I say leveraging cash. But you don't own either one of those trucks yet at this point. But then again, neither one of those trucks have made you any money, let alone money to offset the 10 grand or whatever you put down, 20 grand you put down. Give you, for instance, I like to use this example because I think it really drives home the point of buying cash, paying cash for something up front, is we can probably all agree that the number one resource you guys have is your team members. That's why defense guys are talking about, giving them all the benefits in the world, because that is the best resource we have. It's better than any super fencer truck. But if you use that, if you agree that that's the number one resource, if a super fencer, legitimately a person, were to come through your door and say, man, I've been building fence for 30 years. I eat, sleep, drink this stuff. I just want to run a crew, and I'll do it for 100 grand a year. Most of us on this call would do everything we could to hire that person. Hell yes, put them in play. Let's go. But there's one caveat. They say, however, I want my first 5 years paid up front before I start. And I think that's when the wheels fall off the track, because I think everybody in this group will be like, whoa, hold on, $500,000, you haven't built the fence yet? That's exactly the same thing you're doing when you pay the $50,000 for that truck on day one instead of financing over 5 years. Is you just paid for that truck and hasn't even been to one job site, hasn't made you one penny, and it's not even your number one resource. So for me, that's when it started clicking. I'm like, oh shit, makes a lot of sense. But when I grew up in the defense business, we had no credit, so we couldn't get a loan to go buy trucks. We were for 15 years, let's say 15 years, pretty much in a pretty bad shape. Didn't even have credit cards. So that's a loan, leveraging cash. But there's this other thing called leasing that is very interesting. So if you understand the concept of leveraging cash and making it stretch, there's another option, and that is leasing. And when we hear the word leasing, most of the time people cringe and get defensive and say, oh, no. No, I'm not going to lease. What do you do about mileage? What do you do about turning up all this stuff? And I learned that there's such a thing as called track lease, and there might be other types of leases as well, but track lease is through an independent leasing company. It's not through a dealership, and it's a company that's just like what Tyler defense guys were talking about, is that it's like leasing team members. The team members work for them. They're a leasing company. Well, this leasing company here buys whatever I want them to, and then they lease it back to me. So I literally go and find a used skid steer, a brand new truck, an excavator, brand new, or whatever it is, and I send it to them and say, will you buy me this, and then lease it to me? That's how that works. And the way that they get the value or the lease payment comes from the difference of what you're going to use out of that resource and what it's going to be worth at the end. So what you pay for it and what it's worth at the end. So what they call that is a residual. The residual is what the resource will be worth at the end of the lease. So if you have a 4-year lease, that's typically what we see, 3 to 4 years. You have a 4-year lease on a $100,000 truck. You're going to agree with them, and they're going to give you some calculations based off some statistics, but they're going to tell you that truck is probably going to be worth $50,000 in 4 years. And you have to agree to that 50,000. Oftentimes what I'll say is, nah, it'll be worth 45,000. See, I lower the residual. When you lower the residual, it's going to increase the amount of money you're paying on the lease. So if it's a $100,000 truck and the residual is 50, or you guys agree to 45, the difference is $55,000. So all you have to do is pay a lease payment to use the $55,000 portion of that truck. Whereas a loan would be, you would be paying a loan payment to pay for the $100,000 worth of that truck over that 4 or 5 years. That's why the lease payment is typically lower. Now, the lease interest might be slightly higher than what you're going to get in a loan. Not by much, but a little bit higher. It's just like a loan. But that's expensible. In other words, we can get tax credit for that, right? So it's expensible. So we're splitting hairs if we're worried about a couple of percent. If you're making that kind of money, then really you don't even give a crap about the couple percent anyways. So the 55% is what you're paying on, which is 55,000 in this example. That goes over 4 years. What's interesting is at the end of the lease, you have the option to release it at the residual of 45,000 over. Typically, it's like a shorter term, 3 years. So now you've literally been paying for this resource, like a rent payment, but now that's a dollar buyout on the second lease. So when you're done, you own it. You literally paid or rent to own a truck, but only paid smaller payments for what the value of the truck you were currently using. Or at the end of the lease, you can turn around and say, I don't want it, and take it to a dealership, trade it in on a brand new one. And if they give you $50,000, you get to keep the $5,000 difference, or $55,000 for it. You keep the $10,000 difference. Or if you beat the holy crap out of it, and it's only worth $40,000, then you have to make up the $5,000 difference, which is why the second lease takes that risk out of the equation. It's your vehicle. How you treat it is how you treat it. So at the end of the lease, you're paying $45,000 for the second lease. Period. Even if it's worth 55, you're still only paying 45. If it's worth 40, you're still paying 45. That was a residual. And for a dollar buyout, you would lease it again. At the end of that, you would be done with it. I have been doing this since 2015, and I have leased the Raptor that we have, all of my trucks that I drive personally, all of the 650 Super Fencer trucks. We lease that giant 306 excavator. Bobcat we have leased. Truck that on drove lease. Al's truck drive for the lease. The other thing about leasing, guys, is this. 100% of that lease payment, the interest and the payment, all of it, is expensable in your overhead expense. So therefore, it's no different than having a fast depreciation tax credit when you buy a vehicle and try to do a fast depreciation on it. The cool thing about it is when you do it the other way and you go buy an asset with a loan, and then you tell your accountant, I need some tax credit because we made too much money, and they do a fast depreciation on that, which is going away next year, by the way. They're cutting it down, I think, much lower. You can't get 100% anymore. But let's just say you get 100% tax credit, so you paid $100,000 for that truck on a loan. You might have only made payments for $20,000, but you can take a $100,000 credit off your taxes, which saves you, if you're in a 30% tax bracket, technically $30,000 on said $100,000 truck. And so some people were buying trucks just so they can get the tax credit and do a fast depreciation. The problem is it gets a little bit messy on your balance sheet. because when you paid for that truck, you have a loan and you have a asset. Well, when you get the loan, you put the asset on there. You do a fast depreciation. You're immediately taking all of that off. So now it's worth a zero in your books, and you have a loan for it. Gets a little bit messy. You got to do some creative accounting to clean that back up to try to make it real. It's a lot of extra work. A lease payment is 100% expensible, and you don't have to do any fast depreciation. You don't have to do anything in your books. It never hits your balance sheet. So it doesn't even look like you own the truck as a resource. And it's expensible in equal amounts to the by the month, right? So every month you make $1,000 payment, $1,000 comes out of your net profits. But again, that's expensible, and you're going to save 30% on that. If your tax bracket's 30%, then that same truck you still save $30,000 over the life of that truck for 100 grand because you're able to expense the entire cost of the truck. So leasing is very advantageous. Talk to a leasing agent about it. They can explain it better than I can. But when you get people that are old school, they just get closed-minded. Matt Warner, good friend of mine, he's one that'll tell you he disagrees wholeheartedly, wants to buy things for cash. But Matt Warner has a lot of cash.
Yeah.
So when you get to a point where you have a lot of cash, leveraging cash, depending on what your growth is, may be a little different. May be different. But a lot of guys in that $1 million to $3 million, even up to $5 million, don't typically have a lot of cash on hand. They're in growth mode. And in growth mode, all your cash is eaten up in payments, debt service, loans, resources, which are assets, and then customer AR, accounts receivable. That's where people's cash lives in that growth mode. So I think for him, when he's a $21 million, $25 million company, that's a little different type of accounting. But the $1, $3, $5 million company, I should seriously be thinking about leasing. Does that make sense, guys? Who's got questions on that?
Not everybody.